We are in a strange time. Everyone says AI is the future. Big companies talk about AI every day. Big money follows. New tools appear fast, but many don't help much yet. Some say it looks like a bubble. Some say this is dumber than WeWork. The promise of any tool: make work better, faster, or cheaper. That's productivity. Spend money, expect ROI. AI promised to automate tedious tasks and reduce errors. But the evidence is thin. A major NBER study, 6,000 CEOs surveyed across the US and Europe. 90% reported no impact on employment or productivity. All the hype, and for most, nothing changed. When a tool is useful, people flock to it, organically. The iPhone spread because workers chose it. AI often looks like the opposite: forced adoption. Your phone swaps Assistant for Gemini by default. Word nudges you with Copilot. Social apps push AI features you didn't ask for. It's a way to inflate user numbers. Some firms even tie performance to using AI. That's coercion. For info tools to help, they must be trustworthy. GPT, Gemini, Claude, powerful, but there's a catch. They hallucinate, confidently making things up. They can invent sources and misquote people. OpenAI research acknowledges hallucinations are inherent. If you must verify everything, you lose the speed advantage. They risk becoming confirmation machines. For high-stakes tasks, that trust gap is a deal-breaker. The AI boom runs on an incredibly expensive and voracious fuel: computational power. We're not talking about a few extra servers. Training a single flagship model can cost tens of millions of dollars in compute time alone, burning through electricity like a small city. And this isn't a one-time expense. Models require constant retraining and fine-tuning just to stay relevant, meaning the meter is always running and the costs are always accumulating. At the heart of this gold rush are NVIDIA's specialized GPUs, the undisputed workhorses for both training new models and running inference on existing ones. Led by Jensen Huang, the company has cornered the market with chips like the H100, which can cost over $30,000 apiece. AI companies need thousands, sometimes tens of thousands, of these processors networked together into colossal supercomputers. These chips are not only pricey, they also go obsolete in a year or two, creating a brutal cycle of upgrades. The relentless pace of innovation means today's cutting-edge hardware quickly becomes tomorrow's expensive e-waste. This hardware is housed in massive data centers that guzzle astonishing amounts of power and demand extreme cooling. The energy required to prevent these dense clusters of chips from overheating is a huge operational cost in itself, often requiring dedicated power substations and vast quantities of water. The scale of investment is staggering. OpenAI is reportedly seeking over $100 billion in funding, with plans to spend hundreds of billions more on the compute infrastructure needed for its ambitions. The business model is equally challenging. For many AI services, the cost of running a query is disconnected from the price a user pays. Some power users can consume 10 times more compute than their subscription covers. For the provider, that's a bonfire of cash. This bonfire is fueled by money from venture capitalists, private equity, and tech giants who are pouring capital into the ecosystem, often in the form of debt or complex cloud credit deals. It's a fragile, self-reinforcing circle. The promise of future breakthroughs justifies today's massive spending, which in turn funds the hardware needed for those breakthroughs. The entire system is kept alive by belief and a continuous flow of very large checks. The WeWork comparison isn't just a joke, it's structural. Creative metrics masked ugly truths, a grand story, big backers. Then the numbers hit daylight. Today, OpenAI, Anthropic, and backers like Microsoft and SoftBank. Predictions of superintelligence abound. Enjoy your job while it lasts? Meanwhile, cash burn is massive. Assets? Mostly code, models, talent. If it's unsustainable, there's little left to salvage. It's WeWork too, only bigger and dumber. In venture capital, there's a cherished story they tell about transformative investments. It's called the J-curve. The idea is simple and seductive. You endure a period of significant, painful investment, a deep dip, before soaring to unprecedented returns. It's the foundational myth of Silicon Valley, the promise that justifies burning billions today for a world-changing, profit-gushing tomorrow. But the AI build-out isn't a traditional infrastructure play. When we laid fiber optic cable, that was a one-time generational investment. The glass in the ground would serve us for decades. The GPUs powering the AI gold rush don't last decades. They barely last a few years before a new, more powerful, and absolutely essential generation renders them obsolete. This isn't one dip into the red. It's a perpetual cycle of spending just to keep up. It's a treadmill of compulsory upgrades, where the price of staying in the game is a constant, multi-billion-dollar refresh cycle. You're not investing to get ahead. You're spending just to tread water. And so, the promised payoff remains perpetually just over the horizon. It's always a few years away, always. With every new model architecture and every new hardware generation, the bottom of the J just gets longer and deeper. The horizon of profitability keeps moving further away. It's a narrative that is incredibly convenient for those asking for trillions in capital to fund this arms race. Their message is simple: just trust us. The breakthrough is coming. But for how long do we wait? How much capital do we burn chasing a future that never seems to arrive? The numbers aren't a forecast. They're a ransom note for the next round of funding. When the timeline for returns is infinite and the cost is endless, it starts to sound less like a business analysis and a lot more like an act of faith. WeWork gamed metrics. The AI boom games them too. Defaults create users, not demand. Big numbers in PR, weak usage in reality. Money in as cloud credits, money out as cloud revenue. A financial merry-go-round that flatters both sides. In a stricter regime, cloud credit investing would face heat. If it's so good, show us the S1s. IPO filings would tell the true story. This is built on mountains of debt. Private credit borrows from banks, then funds data centers. No tenant? Unprofitable instantly. Expansion already pausing where AI tenants don't pay off. NVIDIA must sell staggering sums each quarter to keep pace. That money comes, ultimately, from banks. Don't look down at the numbers, they say. The moment the market looks, gravity hits. The AI story is powerful, a potent mixture of hope and fear that captures our imagination. We're promised a future of unprecedented progress, a world remade by intelligent machines. At the same time, we're warned of existential risks and societal upheaval. This grand narrative is compelling, driving headlines and boardroom conversations around the globe. But a powerful story isn't a business plan, and the relentless hype cycle isn't a substitute for tangible results. When the applause from the keynote fades, leaders are left with the difficult task of separating science fiction from sound investment. They must look past the promises and focus on the practical realities of implementation. Because on the ground, the picture is often far less glamorous. We see flat productivity gains, with employees forced to use clunky, untrustworthy tools that don't integrate with their workflows. We see massive, unpredictable bills for compute power and API calls, with costs spiraling out of control. Behind the curtain, we see vast loops of money flowing from investors to cloud providers, financing a mountain of debt for a future that has yet to materialize. It's a high-stakes bet on infrastructure, with profitability still a distant goal for many. This isn't to say it's all smoke and mirrors. Some real, durable value will emerge from this technological churn. Some firms will navigate the noise, ignore the fads, and build sustainable, profitable solutions on a solid foundation. The key is to demand proof. Don't settle for vague claims of transformation. Ask for specific metrics. How much time is being saved on this specific task? By what percentage are operational costs being cut? How is this tool measurably reducing error rates? Remember that big names and big promises Whether it's GPT, Gemini, Grok, or the quest for AGI, don't automatically equal results for your business. A famous brand is not a guarantee of ROI, so stay calm. Cut through the noise by asking simple, direct questions. Run small, controlled pilots. And above all, wait for verifiable proof before you commit. The patient and the pragmatic will be the ones who truly win.